Hi guys, a very good morning. I'm sure you're doing great and I'm also doing great. And I know we all are here together to understand about the basic concepts of costing. Comes a very basic question with it. Ma'am, why are we having this basic concepts class? I mean, when we are doing PM, basic concepts is a concept of MA, right? So why are we doing it here in PM class? For the simplest reason that people, only when our roots are stronger, then only whatever plants will grow will give us fruits, will give us benefits, right? So only when your concepts are foundationally very strong, only then when we go further and we understand the complex topics of PM, then they will be absolutely crystal clear. So today's session we are going to be covering a lot of basic concepts. Like I have just created a list here, and of course I'm going to add on few things also as we just move on in the class. So we will be covering the basic concepts like just a typical basics of accounting, what is typical basics of costing, what is costing, and why do we do costing, okay, the basic reasons, and the direct indirect cost, then fixed cost, variable cost, semi-variable cost, then what is typically overheads and why do we have such different categories of overheads, then over and under absorption of overhead, a basic understanding of marginal and absorption costing. Then going on, one of the more core basic concepts is to understand what is a budget. Why do we do a budgeting? Okay, what is the purpose? And then this one, I have generally found students to be fumbling in this topic. Your fixed budget, flexible budget, and flexed budget. Okay, and as well as the actuals, comparing it with the actuals, just a basic understanding how to have these basic variances covered and so on. Okay, and then we will have a kind of a walkthrough also, again just a touchdown upon topics like TQM, JIT and all, right? I hope I'm clear. Now one thing I want to make it very clear to all of you guys, that anywhere, any questions you have, any doubts you have, you can just put it in the chat box and I will respond to it. And just I hope I'm properly visible, I'm properly audible, and there are no challenges that you guys are facing. Okay, so I think with this note we can begin with the session. So let's start and let's discuss about these basic concepts. First comes a very important pointer, which is what is exactly this thing? What is a cost? Why do we do costing? Okay, why do we take out cost? For what reasons do we do it? First and the foremost understanding is what exactly is costing. So if I put it very simple, I would say costing is to find out the cost. I think it's the most simplest definition that we can have, right? So costing is simply to find out cost of a unit or a product in even for a service. Okay, so we find out cost of a unit or a product or a service. Clear? Now comes again a very important point. Ma'am, do we do costing only for finding out cost? I mean, why do we then find out cost? Because when you relate to it, there are multiple pointers again. First point is you need cost to do inventory valuation. Because we know that inventory values are calculated using the costing concepts, right? So we do it using the costing concepts only. Then secondly is to do costing, to do this costing. Sorry, we need the cost also to calculate or to find out the price of a product. Okay, so in order to find out the price of a product, we need to calculate the cost. Correct. So basically we need the cost to calculate the cost of a product in order to find the pricing and in order to find the inventory valuation. Then again, only when you know cost, only when you know the selling price, you would be able to know the profit margin. Okay, so I hope now we know the basic purpose of finding out the cost of a product. Okay. Okay, now let's go further. So now we know the basic points, that what is a cost. Now let's understand what are the different types of cost. So for that, I will take into account cost and I will write here types. The different types of cost are number 1, number 2. Yeah, first we can do the first categorization because there will be multiple categorizations that we will have. So first will be the direct cost. Another is indirect cost. Okay, now let's understand what is a direct cost, what is an indirect cost. So for that, I think I can take up an example to make you understand that. Okay, now let's take an example that I want to manufacture a pencil, right? I think it's a very basic thing that we all are aware of. So let's do for the manufacturing of a pencil. I will write here pencil. When I say pencil, guys, think of what can be my direct cost. What can be my direct cost? My direct cost can be the wood that is going in to make that pencil, right? The wood, the graphite, okay, because I would need that to make the lead, right? So that is the graphite. I have the wood. Now, why I call them direct? Because without wood, without graphite, I won't be able to make the pencil. So direct cost is that cost which you need always to make that product. If you don't have that cost, boss, you cannot make that product. Okay. So now this is my direct material. Clear? Next, I would need labor also. I mean, see, we will have different materials, but I just taken 2 materials. I would need labor also, that labor which will go on in making this pencil, in manufacturing this pencil. Without that labor, that pencil cannot be manufactured because they are a part of the manufacturing process. Maybe they would just cut the wood, put the lead inside, right? So without that labor, we cannot do it. So we call them direct labor. So direct labor are the ones who are manufacturing the pencil. Right? So direct labor are the ones who are manufacturing the pencil. Clear? Now, let's take one more example. So now I can have a direct expense also. Let's say I need that plastic wrapper to be wrapped around that pencil, no, that carries the logo. So I need that glue to be there. And without that glue, that pencil wrapper cannot be fixed. So it is that direct expenditure which is going on in making that pencil. So I would have some direct expenses also. Now, do you understand why do I call it direct? Because without those material, labor expenses, boss, that pencil cannot be manufactured. Okay, so now we call it as direct expenses, which is like the glue to stick the plastic around the pencil. Clear? So now these were all direct expenses. direct. Now let's look at some indirect expenses also. Think of what can be the different indirect expenses. I think we can list on indirect expenses as indirect labor. What is an indirect labor, or what is an indirect expense? Indirect expense means that expenses, though that is a part of your manufacturing process, but without that expense also we can manufacture the pencil. Okay, let's say I have 10 pencils manufactured, then I put it in a carton, right? So that it's ease. So that is my indirect labor, the ones who are doing that packing, because pencil is already manufactured. Now we are just doing it in a secondary packing box kind of. So that is my indirect labor which is working on it. Okay, now for that I would be needing indirect material also. Maybe I would be needing, let's say, we have this packing cost. So that we have indirect expenses. Which is like the secondary packing cost. And we can have indirect material as well. Okay, indirect material typically are like those screws and all consumables and all that goes into it. Okay, so now here we can have an indirect material. Let's say I have to get the pencils. Maybe we sometimes give caps also, to decorate the pencil and to make it more saleable. So all that can be the indirect material, that even without that the product can be manufactured. But to make it in a completely ready for, after production, I need these expenses to be incurred. So these are known as indirect expenses, like indirect labor, indirect expenses, and indirect material. Typically, we call them also as indirect cost. Okay, we also call them as indirect cost. I hope now this differentiation is absolutely clear with everyone about the direct and the indirect cost. So don't forget to have that pencil example in your mind whenever you are stuck with this basic concept. Now let's go further. If you have any doubts, you can ask me. And people, we are going to take up examples also to absolutely make it crystal clear in your minds. Okay, now going on to the next one. So now when I take the topic, we have covered the basics of costing. We have covered direct, indirect cost. And I can just give you one more example like I given you earlier. This one pencil example. So here I have kept that pencil example for you, which will be shared in notes with all of you. Okay, don't worry for that. So I gave you this example and here I have just explained it. Now I will take one more example and then we will go to just a basic understanding of a simple cost sheet. Okay, so one more category that I want to discuss here is the types of cost as per the nature. So what do I mean by types of cost as per the nature? Let's look here. Nature means what is nature means what is the type of cost like. Okay, so whether that cost is a variable cost, whether that cost is a fixed cost, or that cost is a semi-variable cost. So here I will have three categories. 1, 2, 3. Okay, first is variable cost. Second is semi-variable cost, and third is fixed cost. And we will also discuss the peculiar features about this cost. Okay, what are the peculiar specialties about this cost? We will discuss that as well. Now quickly going here, what is a variable cost? Okay, what is a variable cost? It is that cost that varies with the level of output. Okay, output or input, whatever is the case may be. So now let's say that if we produce 10 items, then we will have to incur the cost for these 10 items only. Okay, I won't be incurring the cost for the next 11th item. Let's take the example of the pencil manufacturing only again. Now just think that if I'm just manufacturing 1000 pencils, Okay, if we are just manufacturing 1,000 pencils, so my quick question to all of you, which I'm sure you can answer, that ma'am, what will be the cost that will go on in manufacturing these 1,000 pencils? What will be the direct material cost? For how many pencils you will incur the direct material cost? 1,000 pencils only. You will hire the labor to manufacture how many pencils? 1,000 only. You will incur those direct expenses for how many pencils? 1,000 only. So what do you observe? When a direct cost, I am only incurring for the number of pencils that we have manufactured. Got it? So they become my variable cost. Why? Because variable cost means that cost that moves with the number of units manufactured or produced. So now let's say if you manufacture 10 units, your variable cost will be for 10 units. If you manufacture 0 units, your variable cost will be for 0 units. Okay? Now, another point. Ma'am, what about the indirect cost? Is indirect cost never variable? Yes, we have variable nature there also. I can take a few quick example. You know that, right? The electricity cost. So let's take the example of electricity cost. Okay. Now we know that when we incur electricity cost, that is not just for the pencils. Let's say the company is making pens also, erasers also, that electricity is for the entire factory. Correct? So that is an indirect cost, because it is not directly related to the making of pencils only. So this is an indirect cost. But have you ever seen the bill of electricity? I'm sure you all get electricity bills, right? So when sometimes it is quite, big in amount, sometimes it is reasonable, but we all get electricity bills. Now just have a look at the bill and you will find that it contains two things. First, your electricity bill always has some fixed component. And another, it always has a variable component. Variable component means based on the number of units that has been consumed, your electricity cost is calculated, right? The number of units multiplied by the rate per unit. But there is always a fixed component also that says, but this is the fixed amount that you will have to incur. Though this is a type of a cost that we classify under semi-variable. But I would just give you an example here, that here this also has a variable component. So we will segregate fixed component and variable component will come under the variable cost, and that we call as variable overhead. I will explain you the concept of overhead also in just some time. But it is an indirect cost which also has a variable component. This is what I wanted to discuss here. Okay, so even indirect cost have variable components in there. It is not necessary that indirect cost will always be fixed. So the fixed component will go to the fixed cost, variable component will go to the variable cost. I hope I am absolutely clear on it and with no confusions, no doubts. Right? So now we know clearly what is a variable cost. Right? Now let's discuss about what is a semi-variable cost as well. In the meantime, if you have any doubts and queries, dear friends, please put up in the chat box. I will reply you back for your queries. Okay, I think now we can move forward. So now we know about the variable cost. Variable cost is the cost that will vary with the number of units manufactured. Okay, so the less the number of units, less is the variable cost. More is the number of units, more is the variable cost. Okay, then semi-variable cost. Semi-variable cost, like I gave you the example here of the electricity cost, semi-variable cost is the cost that has features of both variable and fixed, like the electricity cost. So what do we do here? I need to segregate this and between the variable cost and the fixed cost, and then we take it to the respective heads. That is why when we do costing questions, we always find variable cost and fixed cost to be there. We don't never find semi-variable cost as a component in the cost sheet, because we always segregate it between variable and fixed and then take them to the respective places. Now, and there is a method of segregation we will study in our PM as well. That is the high-low method. Okay, so to segregate it, we have high-low method. We will cover here as well. Okay, now coming to the fixed cost. Fixed cost is that cost that is going to remain fixed for a period, okay, or till a capacity level, and it is not expected to increase. For example, I have a factory which I have taken on rent, and that has a capacity to manufacture 20,000 units, okay, and the rent of that factory is 10,000 per month. Okay, so till my capacity is 20,000 units, I am going to incur 10,000 a month. So whether we make 2 units, or we make 5,000 units, or we make 10,000 units, or we make 20,000 units, we will have to incur the rent expense of 10,000 per month anyhow. So fixed cost is always fixed for a period. Variable cost, you will see that it is always fixed for a unit, but never for a period. Okay, so that is a very, very big difference between fixed cost and a variable cost. Okay, now fixed cost, I think I'm absolutely clear about it, that fixed cost is the cost that is going to remain fixed for a period, like rental expenses. Now, your question can be, ma'am, what if the capacity increases from 20,000 to let's say 30,000? Then you will have to increase the factory space, additional fixed cost will be incurred. So then you will have to step up the fixed cost, right? So then comes the concept of step up fixed cost that says that when your capacity level elevates, now your fixed cost will be increased to meet that level. Okay, and again it will remain constant for a period. Again there is an increase, again it will increase. So you will always find the pattern of that fixed cost to be like this is fixed, it increases, fixed increases, fixed increases. So it's more like a step up mode. So we also call it as a step up fixed cost. Any questions, any doubts you can put up here. Okay, so now I was coming to one point that I explained you. I will just take it again here. When it comes to variable cost and when it comes to fixed cost, few things you have to keep in mind. I told you that fixed variable cost will be the cost that is always going to move with the number of units, right? So if my number of units increases, let's say I assume the number of units sold have increased, so your variable cost will also increase or produced. So okay, now if your number of units manufactured reduces, your variable cost to manufacture will also reduce. So what do you observe here? That here my variable cost moves with the level of inputs, correct? Now that means it is definitely not fixed in value, because if there are 10 units, you will have cost for 10 units. If you have cost for 100 units, you will have cost for 100 units. Clear? So value wise, remember, value wise your variable cost is not fixed. Overall value for variable cost is not fixed. Okay, so then means, ma'am, what is fixed? Now I'll just show you a graph just for your understanding. Okay, let's say these are my units and this is my cost, variable cost. So now as you will incur 1 unit, you will have 1 cost, 2 units, 2 cost. Your graph will look like this. So what do you observe here? Your per unit cost will always remain same. So variable cost has got a peculiar feature that in variable cost, your per unit cost is always fixed. I hope now you know why. Okay, that your per unit cost is always fixed. Clear? Right? For fixed cost, remember what now? Can I have a per unit cost fixed for fixed cost? Think. Can I have per unit cost fixed? Can I say that my rent cost per unit is, let's say, coming out to be always 200 per unit only? Will it be always like that? Now let's take an example to prove it. Let's say my rental cost is 10,000 in a month. In the first month, we made 100 units. In the second month, we made 200 units and capacity is still 20,000. Do you see that the per unit cost here is 10 and per unit cost here is 5? It is not constant. So now when I say it is not constant, what does it mean? It clearly shows that your fixed cost can never be fixed per unit. So what do you find fixed here? What do you see? Your amount is same. That means your fixed cost is always fixed for total amount or value. Okay, so remember it now, people. A very basic nature of your cost. Your variable cost is always constant per unit. Your fixed cost is always constant in totality. Up to a certain level of capacity or the period, it will always be fixed for that period. So fixed cost will never move unit wise and variable cost will never be fixed in totality. Any questions, any queries, you all can put up here. Clear? Now let's understand few more concepts and then we will start taking a question. So we have covered the types of cost as per the nature as well. Now let me just touch down upon few things. I will cover here one concept which is overheads. We have covered indirect costs, so I think now we can cover in detail in overheads also. So overhead and indirect cost is one and the same thing. Okay, overhead, over the head of the basic cost, over the head of the direct cost. So any expenditure that we incur over and above the direct cost is your indirect cost, or we simply put up it as a overhead cost. I hope I'm all absolutely crystal clear here, because many students, they come and say, ma'am, what is an overhead cost? I mean, even now when we're in the PM level, we're still not clear. So just simply remember it. Overhead cost is nothing but the indirect cost. Clear? Absolutely. Now I would just like to differentiate this overhead cost into the production cost. Okay. Into the production cost and the non-production cost. Production cost means, as the term says, that it is the cost relating to the production of the product, manufacturing of the product. So what is the indirect cost relating to the manufacturing, and what is the indirect cost which is other than production? So like production cost can be, for example, we are working on a machinery, right, to manufacture the product. The depreciation cost of that machinery is an indirect cost. Okay, we do schedulings, we do production runs, right? We do unloading, loading, all this. We do material handling. These are so many different examples of your production cost, which is indirect. For example, on the factory floor, apart from the labor, we also have supervisor who looks into everything, right? Who supervises all the production processes which are going on in a factory floor. Let's say that the company is manufacturing a pencil, a pen, eraser. So supervisor will look into all the three areas. He's not just looking into the pencils manufacturing or only one, that particular pencil manufacturing. He's been hired to look into all the production floor manufacturing. Correct? So that is basically your production overheads that we discussed. Okay. So now when I say that, the question comes in, ma'am, how do we put that supervisor salary in our books? Should we put it as a direct cost? Of course not. Because even without that supervisor, the pencil is getting manufactured. Correct? So now supervisor's salary is allocated between the three different products, like pencils, like erasers, like the pens. That I will tell you later how do we do the allocations. But one thing we are very clear is it is an overhead cost. Now it is an overhead cost relating to what? Relating to production, selling, distribution, administration. Tell me. Can you put it in the chat box? Supervisor's salary is an indirect cost or an overhead cost relating to production, relating to selling, relating to, administration or distribution. All of you can put it in the chat box. What is your answer? Yes, yes, absolutely correct. Absolutely correct. Yes, it is definitely a production related overhead because supervisor is looking into or supervising the production related expenses or production related activities only. So very good. Now friends, you are clear. We will have it as production cost. So I'm just telling you this again, just like a summary here. Your production cost is divided into two categories. Direct cost, which we also call as prime cost. So when you add direct material, direct labor, direct expenses, the total of the three gives you prime cost. Okay. Indirect costs are those production related overhead when it comes to production cost. Because for us, most important is to calculate production cost, based on which only we know what is our manufacturing cost, how much cost would be going into the other heads like selling, distribution and all, so that we know what is the margin that we can carry. So production cost is the most important cost that we calculate. Indirect cost of production overheads, like I also gave you example, supervisor's salary. Okay, supervisor's salary, electricity expenses, depreciation of machinery, factories rent, all this will go in the production related indirect expenses. Indirect expenses we call as overhead. Very good, very good. Perfect, very good. Non-production costs are those costs which are not going in for production related activities, like general costs, like administration costs, like the different like the office AC which is provided for the staff, which is not basically the labors. So that is a general cost. Administration cost, selling cost, distribution cost, your advertisement cost. We do the big cartons, secondary packing, so that the logistics movement become easy. So that is also distribution cost. So all these costs we cluster together and we put them under non-production cost. Okay, I hope I'm absolutely clear till this point. Any challenges, then please put up in the chat box. Okay, we can have cleaners cost, we can have postage cost and so on. So now, if I put it very clearly, we have been able to cover the topics like basics of costing, direct, indirect cost, types of cost as per the nature, and broadly now we know about what is overheads. Okay, now I think it's the time if we can take up a question so that all of your queries as to how do we prepare a cost sheet, how do we put all of these together at one place becomes absolutely crystal clear. Right? So all of us, let's do this question together. All of you, come on, do it with me. So let me take you quickly to this cost sheet as well. First, now we know everything for the cost, right? Direct cost, indirect cost. I think let's look at the performer so that we know how do we prepare a basic cost sheet. Okay, so now here we have direct material, direct labor, direct expenses. We know about these three things. Yes, direct material, direct labor, direct expenses. You add them together and they become your prime cost. Then we add overheads. Like first, obviously, we will add production overhead to get the production related cost. Now in the production overhead, I will add variable overhead. I will add fixed production overhead. You add variable overhead, variable production overhead. You add the fixed production overhead, and then we get, though I have not added here, but then we get the production cost. We get here, if you want to get the total, you can get here production cost. Now with the production cost, we will add the general and general administration overheads. We will add the selling and distribution overheads, which is other than production. And then we will add and we get the total cost. So total cost is basically production cost plus non-production cost. Okay, and we get total cost. Then with the total cost, I will add margin and we get pricing. And this is the selling price that becomes our final price to consider. Now, if the question asks you to calculate total cost, see, I know it is an MA point, but for PM also it is always sometimes a confusing point with the students. They tend to ignore one point, that whether the question is asking you cost per unit or total cost. Understand, we always prepare the cost sheet per unit. Though even if you prepare it totally, I mean, it's not wrong, but typically the cost sheets which are given to you in the exam is also per unit. So keep this in your mind. And if you have to calculate total cost, then you simply have to take this total cost per unit and multiply it with the number of units. One more pointer we have already covered, but I have already told you here again that we will always assume, that's a basic assumption of costing that we carry, that variable cost per unit is constant always unless otherwise mentioned in the question. Always. And by default assumption for a fixed cost is that fixed cost in totality is always constant. So now I think we can discuss one more point, the relationship between fixed cost and the variable cost that we call as a total cost function. We will use throughout our PM syllabus. The basic concept here will be covered throughout the PM syllabus. And what is that basic concept? The basic costing equation. Don't forget that, my friends, because it is always going to be there for you. In the exam, you need to have hold of it. So your basic costing equation is that total cost is equal to variable cost plus fixed cost. I will break it here. Okay, total cost is equal to variable cost plus fixed cost. Okay, I think let's divide it. Let's just not divide it, sorry. Let's just, detail it. So now I can detail it as what is variable cost. If I keep that assumption variable cost per unit, then how would you calculate variable cost? It will be variable cost per unit multiplied by number of units. Why? Because variable cost always moves with the number of units. I hope I'm absolutely clear here, and logically we know things. We are not rote learning, right? Logically we are understanding things. Now, how do we calculate fixed cost? You know that fixed cost in totally is constant. So you will always have here directly calculated total fixed cost. Okay, so you will take variable cost, you will do the calculations as total variable cost, which is variable cost per unit multiplied by number of units, and fixed cost will be total fixed cost. Any questions here you can put up in the chat box. And this is the same equation that we will use in high-low method also to segregate semi-variable cost between the variable cost and the fixed cost. So you can see it is such an important basic equation that will be carried throughout your PM syllabus. Done? Clear? Now let's go further. So now we know about this basic costing sheet, and now I think we can do a question so that we have absolute hold of the topics. Okay, so let's try out this question. I have taken one example here which I will solve parallelly in the notes. Okay, so that we are on the same track. K Limited makes 2 products. Information regarding one of those products is given below. What is that information? Budgeted output or sales for the year is 900 units. Remember, we have to take 900 units. Direct material is 40 square meter. So 1 unit, just see the equation like I told you. Your cost sheet is given generally for 1 unit only. Okay, now there is a term written here, standard. There is a term written here, budgeted output. I will take this in a while. Okay, but just now let's understand how to prepare a simple cost sheet. Okay, so now for 1 unit, direct material required is 40 square meters at 5.3 per square meter. Okay, so let's do the calculations here. I think we can do it here as well. So when we do it parallelly, it will become much clearer. Okay, let's do it here. So what are we required to do? Prepare a standard cost card for 1 unit, and you have to prepare, listen, they just want us to calculate cost per unit. So we will do it per unit calculation only. Okay, and enter on the standard cost card the following subtotals. Prime cost. Okay, then they want variable production cost. Then they want total production cost. And then they want total cost. Okay, so let's calculate these 4 items. Okay, let's do it here. So what I will do, I will write here solution, and I will write here calculation of standard cost per unit. Okay, let's calculate the standard cost per unit. So first I will have direct material. Figures are in dollars, and I will have direct material. What is the direct material cost? Okay, I can just type it here. So that is 40 square meter multiplied by 5.3 per square meter. So I can use the formula 40 square meter multiplied by 5.3 per square meter. So I get 212. Okay, I get 212. Now let's go further. So now we have direct wages, and understand we have direct wages for 2 departments. Okay, first is for the bonding department, another is the finishing department. So let's have the direct wages. First we will have for bonding, and then I will have for finishing. Okay, let's have for bonding here. So again, let's do the calculations. Bonding department for 1 unit requires 24 hours. 1 unit requires 24 hours, and the rate per hour is 5. You can simply multiply it to get the rate per unit. So it will be 24 multiplied by 5. Okay, we get 120. Clear? Now we can see for finishing, it is 15 hours at 15.8. So I will have 15 hours multiplied by 4.8. Which is 72. Okay, so I get for bonding, my labor cost is my labor cost is 120, and for finishing my labor cost is 72. I hope I'm clear with it till this point. Now I will have variable overheads. But first, my requirement of the question was to calculate prime cost. I have direct material, I have direct labor. There is no information about the direct expenses. So what I will do, I will just take the totals and get here my prime cost. So my prime cost will be, for this, I will add the two. So I will add this plus this, right? And we get 192. Okay, so this is 192. This is my prime cost. So we got the first answer that the question desired. Now let's add the variable overheads to get the variable production cost. Okay, let's do it. So let's add variable overhead. Okay, variable overhead is given here. Look here, for bonding, it is 1.5 per direct labor hour. Direct labor hour for bonding was 24. Just the rate has changed for variable overhead, which is 1.5. Likewise, for the finishing labor hours also, only the rate has changed. So that's what we are going to do in the formula. So I will just calculate both the portions here together in the formula. So we will use brackets also to calculate. So I will write equal to, and I'll open the bracket. I will do the first calculation, which is 1.5, and how many labors are required for bonding? 24 hours. So I will multiply with 25, bracket close, plus I will do another bracket which is for finishing, 1 per finishing labor hour, and finishing department requires 15 hours to make 1 unit. So I will do 1 multiplied by 15. Okay, bracket close, enter, and we get variable overhead is 51. You got your variable overhead because now the question required variable production cost. So I will calculate here variable production cost. Variable production cost will simply be total, will be the total of 192 plus 51. And I get here 243. So I get my variable production cost is 243. Clear? Now we will just add fixed production cost and get the total cost. But remember, I need it per unit. And fixed cost is given to me in totality. So I have the number of units given to me. I can divide it to get the cost per unit. Why? Because I need this cost sheet per unit. Okay, I will just check it. Gemin. Oh yes, we forgot to add this. So okay, I will just add it. So I will add the material cost. Yes. Thank you, Gemin. Yeah, so we got the prime cost as 401, our variable production cost as 455, and thank you for being attentive. Okay, and next we will add the fixed cost. So let's add the fixed cost. Remember, you have to add fixed cost per unit only, because the question is requiring you to calculate the cost sheet per unit. So I will add here cost per unit. Again, repeating how to do it. We got the total fixed production cost, because the question is only wanting us to calculate total production cost first. Okay, so total production overhead is 36,000 divided by the number of units, which is 900. So I will get my fixed cost per unit is 40. Now you add it and you will get your total production cost. So I will write here total production cost. So my total production cost will be, we have just calculated variable production cost. With this, we will add fixed cost. So I will add variable production cost plus fixed cost per unit, and my total production cost comes out to be 495. I hope we all are absolutely crystal clear till this point and there are no challenges. Now, question also wants us to calculate total cost. So what we have not taken so far? Tell me. In this cost sheet, I have taken direct material, direct wages, variable overheads, fixed production overhead. But what we have not taken so far is fixed production, non-production overheads, right? So again, here I will add fixed non-production cost. Okay, so what is the fixed non-production cost? Again, we can calculate it. So we will have, what is the total cost? 27,000. Number of units were 900. I will divide it 900 and we get 30. Okay, now with this 30, I will add here to get the total cost. So let's have the formula. 495 plus 30. So my total production cost comes out to be 525. Okay, this is my total cost. Okay, I hope I'm absolutely clear. Total cost. Now, any questions, any doubts that you may have, guys, all of you, put it in the chat box right now. But I'm sure after this, you guys should be absolutely clear on your basic concepts of costing. Okay, I think now we can move forward and let's understand one more concept before I take up the last portion. Okay, so I would like to take one more concept here. Please look at my screen. This is the concept that I want to take here. The concept of markup and margin. Okay. As a quick note, would anybody like to answer this? That how do we calculate markup and how do we calculate margin? I've always found challenges in the students, with the students. They always fumble and they say, ma'am, it's very confusing how to apply markup and how to apply margin. Any one of you can answer that? Yes, so I can see the confusion here as well, right? So then let's move forward and let's understand it and keep it absolutely crystal clear. So my friends, this concept will not just help you here, will help you in PM, will help you in FR, will help you in FM also. Okay, so just have it completely locked in your head. Now, understand here, when I say markup, okay, when I say markup, always remember markup is always on glitches are always a part of it. Okay, now so let's understand why when we say markup is always on cost. Okay, remember it. Margin, whenever we will discuss, it is always on sales. So when we say, the question says there is a profit markup or the question says there is a profit margin, you will always calculate it on the respective cost or sales. What do I mean by this? So always remember one basic concept. So Gemin, yes, that like I said, there is always a confusion, right? Now, so always remember the basic concept. What is the basic concept? Basic concept is, basic structure that you will always have is, you will always take the base as 100. Okay, so let's say if I say that the markup is on cost, so cost you will always take at 100. Okay, if I say markup is on sales, margin is on sales, so then when you have to calculate profit, you will take sales as 100, because then sales become your base. For markup, cost becomes your base. We know the basic costing equation, not the total cost, but the normal cost profit sales relationship, that cost plus profit is equal to sales, correct? The same relationship we will have it here. So let's say if the question says that the profit is on markup, okay, that the profit is on markup, then I will take cost as 100. Now I will calculate, let's say the profit percentage is 25%. I will calculate profit on markup. My markup is 100. My profit is 25% of 100, which is 25. Now you know your cost 100. Now you know your profit 25. So what is your selling price? 125. This is the relationship that you will carry, and I will tell you how to use it. Okay. Now when we say that there is a margin, margin is on sales. Sales is, let's say 100 here then, because that becomes our base. So we will take sales as 100. Okay. Now profit is 25% on the sales because it is margin. So profit will be 25 here. And now you know the relationship. So if sales is 100, profit is 25. How much is the cost? 75. Very good. Now I will tell you how to use it. Now if the question says that, let's say the cost is 500. What is the profit? If the profit is calculated as a markup, then what is the profit? We can calculate it with the help of this formula. So look here. I will use the formula. I will take, what is my cost here? 500. How much is cost representing? 100 divided by 100. And how much is my profit here? 25 multiplied with 25. So you get that your profit is 125, your cost is 500, so your selling price is 625. Clear? I take the same example here, and now I say if my cost is 500 here. Okay, I take the same example. Now here also I will take that, let's say my cost is 500. Then how much is the profit if it is a margin? So just see how can we create this relationship. Now equal to, cost is 500. Now just look at this equation and think how much is cost representing here in this equation. Absolutely correct. Cost is representing 75. So I will divide it by 75 and I will multiply it with the profit. What is the profit margin that I want? 25. I will multiply it with 25. So I get my answer as 167. So in this question, my answer is 167 profit. I hope I'm absolutely clear here. And now you guys are absolutely crystal clear on when I say a markup or a margin. Any questions, any doubts, please ask me. And as regards notes, don't worry guys, you will get these complete notes of your basics of costing, and whether, you know, whoever is wanting those notes, even you can comment in the chat box and notes will be provided to you. Okay, so now we go back to our question, to what we were doing, because there we will use this funda now. Okay, now please look here. So now the next part of the question required you to calculate the selling price per unit. They want us to calculate selling price per unit for a profit of 25%. The profit is 25% on the selling price. And you will say, ma'am, here we don't have selling price, but we do have cost. It is the margin concept. So now we know our selling price is 100. Profit is 25. Cost is 75. Very good. So now can we calculate the margin here? Of course we can calculate. So I will write here profit margin. And let's calculate, people. So now I will use the formula. I know my cost. My cost is representing how much? 75. Very good. Very good. You got it correct. Because sales is 100. Reason being, it is a profit on margin. It is a margin. Margin is on sales. So we will divide it by the cost. My cost is 75 multiplied by 25. Okay, why? Because my profit margin is given here 25. So I will multiply it with 25. I press enter and I get my margin as 175. And now what you have to do, you just have to add it and get the sales price. So I will write here. I will write here selling price, and we get our total selling price as the totals. Just 1 minute. So we can have the totals here. Okay, let's have the totals here. So we'll write here selling price. Okay, now selling price will be total of this. So let's do the totals. I've left 525 plus 175. So we get the selling price as 700. And now that completes our question. I'm sure you all have got the understanding of the same. If you have doubts, you can always put it in the chat box and I will take up all your doubts. So be rest assured, guys, all your doubts I will be taking up. And now let's calculate further. So now we have done this. We have done the basic cost sheet. We have got hold of it. And now let's go further and understand another concept, which is what is standards. What is budget? Okay, because everywhere in your PM, in your MA, you always find this term standards. So always comes a question, ma'am, what is standard and why do we have it in costing? Why do have a budget in costing? Why do we have this budgeted rate, predetermined rate, the standard rates in costing? So I'll just give you a background, okay? I will just give you a quick understanding of it. Guys, do we have actual data available for the goods that we have sold from day one only? You will say, ma'am, how is it possible? Of course not. I mean, you're selling it tomorrow. How can you have it available today only? I completely agree with you. But then I need costings, right? Suppose today I'm manufacturing a product, I need people who would come and tell me, ma'am, what is the cost tentatively that you are expecting for this product? Of course, your actual cost can vary. That's not a challenge. But the point is, we need the cost to start with, right? So every business, they have a predetermined rate, which they determine based on the past estimates, based on their expectations, and based on various other factors. Okay, so they determine the rate based on these all pointers. Now, what do? We take this predetermined rate as the base when we calculate cost. Why? Because we don't have actual data available on day one. You only told me, all of you. So that means predetermined rate is the standard rate that we say. So standard rate is nothing but a term that we use specific to cost. And when I prepare budget for all the other areas, I call it as a budget. And when we prepare for a cost, the cost sheet or cost card, We call it as a standard cost card. Okay, so nothing but the terms are different. That's all. Nothing. Clear? So now we are very clear for this, that this is the standard cost card. Okay. Now I will just take you to a bit more detailing of standard cost, because you would be needing it every time we will have it. Okay, so let's understand a bit more about standard costing. So what is the standard cost? I have already told you. So I am sure you all are absolutely clear about it. It is the predetermined rate. It is that predetermined cost, or it is that predetermined rate that the management is already fixed, and it is always per unit. Okay, so it is that predetermined cost which is always per unit for a product or a service, anything we can calculate, because like for example, I'm providing a service to you, right? So I also need to know what is my cost per hour, what is my cost per student. Okay, so like this we can calculate it. I hope I'm clear. So this is already a predetermined rate. Now you can always ask me, ma'am, that means when we will have the actual cost available, let's say after the end of the period, we can have a difference. Of course. And that is why we have a chapter which is called as variances. Today I will be discussing a brief about variances as well. So we will be touching down upon that as well. Okay, now quickly. So the question comes in, what is the purpose of standard costing? So the main purpose is, like I told you, to do the variance analysis, to do the controlling work, to do the assessment work, that how well the managers are doing for that areas, right? How is the cost per unit as per the expectation, and how much cost was actually incurred. So we know that the managers, the people, they are actually working in the best of the efficiency that we desire or not. So this is controlling, where we calculate the variances, where we try to control, okay, over these differences. So whether actuals and the standards, we try to calculate these differences, and we try to find out the reasons that why there is a difference which is coming up between the actual and the standard. I hope everybody is absolutely clear about it. There are no challenges, right? So now people keep it always on your tips. Standard cost means that cost that we always have to take as a base for calculating the cost of a product or a service. And it is that predetermined rate that would always be used beforehand. Okay? And no questions about it. Any questions? I'm giving you 30 seconds. Put up in the chat box. So I think now we can move forward, and good to know that your queries are resolved here. Okay, now let's go further. So why we need standard costing? Again, more discussions we can have. We need it for planning purposes. Makes sense that we need it for planning purpose. Okay, because we need it to help the budgets, right? Prepare the budgets. As it is the predetermined rates, it would always be helpful to create the budgets. Another point can be for inventory valuation, because again we value the inventory on the basis of cost, and we need that predetermined cost. We cannot wait for the actual cost to take place and then value the inventory. So we will use it for inventory valuation as well. Now accounting simplification, because it is the rate which is available with you, so it is more simplified for the accountants to value the goods as per this cost. So absolutely correct, all of you, and I hope it's absolutely crystal clear to have this understanding. Now, when should we use standard costing for? Let's take an example. Okay, we all go for stitching, right? Let's say I want to get my dress stitched by a tailor, and I have a Mr. A also getting dress stitched by a tailor. Both of us, Miss A, going to the tailor for stitching. Now both of us, even if we're carrying the same material, we'll get it stitched differently, right? You will say, yes ma'am, nobody has the same taste. Obviously, I go with you. Nobody has the same taste, so we will take it differently and we will have it differently created. So then can I use standard costing over there? Can I use standard costing in case of a service? Can I use standard costing in case of a customized product? Very difficult. Why? Because we don't have standard process, right? Okay, so due to which standard costing generally would not be applicable in the most relevant way for a heterogeneous products, the products which are not similar. For a service industry, where every service we provide is different to what we provided earlier, because we don't have, it is always customized and it is always meeting the needs of the user. Correct? So then it is very much suited for when the goods are homogeneous. They're almost of the same types, right? And the mass production is taking place for the same product. Like for example, I'm buying the chocolates. I am buying maybe so many things. Sugar you buy. Okay, you're buying so many things that are always same for all the packings. Okay, so now for them we can apply standard cost, because the cost per unit is going to be the same always, right? So we can apply the predetermined rate because the structure of cost will remain same. So therefore we will apply it to the mass production. Okay, we can apply it to the products when they are repetitively made. Okay, so to the repetitive production we can apply it. Then we can apply it to the mass production, right? And generally, like I told you, generally the businesses where the goods are different every time you make it, like especially the customized goods industry, it is very difficult to apply it. Okay, or even when there is a lot of labor intensiveness involved, because labor intensiveness involves also makes difficult for the application of a standard cost, because every time a human does a work, it will do the work differently, or there will be some changes in the work comparing to the previous work, right? So due to which standard costing is more relevant when you have similar goods produced across, over the time, and it is produced in masses and there is not much difference in them. So then yes, we can apply the standard costing. I hope absolutely clarity here we have. Moving to a bit more about standard costing is, because that is also generally very much tested in the exam, and that is about the different types of standards. Okay, so remember guys, there are 4 different types of standards. First is ideal standard. Second is attainable standard. Third is basic standard. And fourth is current standards. So these are the different standards that can be created. Number 1 is ideal standard. Ideal means the perfection. Like all of you look for a perfect teacher, perfect trainer, right? So that is the perfection that I'm talking about. So now we look for a perfection, that is an ideal standard. Ideal standard means that, boss, it is the ideal environment. People come in, they do the work, there is no wastage, no shortage, complete 100% efficiency of the labor. There are perfect conditions, there are no breaks also. Okay, and there is everything is perfect, and so we call it as a perfect environment, perfect standards. Okay, perfect standards in place, and that is your ideal standards. Right? I hope I'm clear on it. So that means there are no delays. There are no, you can say, breakdowns also. There is no wastage. And you will say, ma'am, is this practically possible to apply? Can I have this application of ideal standards in place? I'll give you examples. Generally, yes, but we put ideal standards for a long-term perspective. Okay, long-term perspective, we have these ideal standards. Because in short term, it's very difficult to apply. So when the company is preparing its 10-year vision, 20-year vision, 15-year vision, 5-year vision, okay, then they apply this ideal standards. Okay, because of course, that time when we are preparing those visions, we don't put a space for the delays and we have delays. We don't give space for those delays as well as the breakdowns and all, because that is always going to take place in the short run. So it is more ideal for a long run. Okay, let's have an example. For example, a car factory sets a standard that one worker should produce 10 cars per day, assuming, listen, assuming there are no breakdowns, okay, there are no sick leaves, very interesting, there are no mistakes, and there is no waiting time. So we are carrying this assumption here. Okay. Now you will say, ma'am, practical, does anybody follows it? Yes. We have a company called Toyota. I think all of you know about it. So Toyota has been able to follow ideal standards perfectly even in the short run. Why do they follow? What is the secret? I will tell you in a while, because there are two other methods that they follow which lead to the following of ideal standards. So in some time we will have that discussion. But yes, practically we do know there are companies that follow it. Okay, look here. Now we have attainable standards. Attainable is something that you can achieve. So I would like to give you one very interesting example. Guys, I give you a target. You have to achieve 90 plus in PM. What would you say? Ma'am, ideal standards. Above ideal standards that you are giving me. Right? 90 plus in PM and I am only thinking of 50% PM. Please don't be in that position. 90% PM is definitely attainable by you all. So if I put it as what can be the attainable levels, I can always put it as 70 plus onwards. So that you will say, yes ma'am, that we can manage. I mean 70 plus, yes we can obtain. Because I've given little bit more efforts and we can definitely achieve those standards. So here attainable standards gave space for breakdowns, for delays, for lagging time and everything. Okay, for mistakes, for errors, and that becomes more practical. So yes, it is a more practical standard or the targets to be met. For example, the same factory sets a 10-knot standard of 7 cars per day per worker, considering small machine downtime, tea breaks, lunch breaks, minor defects, all breaks, walking break, talking break, all those breaks. Okay, so now we consider all of them and then we have these attainable practical standards created. So I hope everybody is clear for this. Now you know ideal standards 90 plus, your attainable standards 70 plus, and guys, you all are going to be in that zone. We will work together to ensure that you are in that 70 plus zone always, all of you. Okay. Third, basic standards. Basic means current levels. 50 is the passing grade. I give you a target to achieve 55 only. So that is a basic standard. Why do we call it as a basic standard? The reason being, okay, so now we have current standards, right? Now current standard is like I told you, you need a passing marks of 50 and I say, boss, can you achieve 50, 55? You will say, yes ma'am, that too, even while attending the live sessions and doing questions, we can attend it, we can do it. So why do I need to put in that extra effort, right? So that is your current standards. That means you are at the current levels. what was the worker doing currently only, you are asking him to do the same level. So you're not pushing him to do better. So you will say, ma'am, then what is the use of having these standards? I mean, why to have them at the place only? Because then there is no motivation here, right? But then just think of a situation like a COVID situation, like of any economic, any economic disturbances happening in your country. Then even achieving the normal levels is a big task. So their basic standards come in place. Clear? So now let's have an example. A textile company fixes the cost of producing 1 meter of cloth at $2 in 2010 and keeps this figure unchanged for years. So even we keep these basic standards for, longer period. For comparative purposes, we do it for a longer period. Got it? So generally we keep it like for 5 years. We have kept the same standard so that we can do the comparisons over this 5 year, and we have not made changes in this 5 years. For example, we have these different surveys that are brought up by the India government, for example, and they are there for 5 years as constant. Then after 5 years, they make changes. So these 5 years, which is held as constant, is the basic standards. This is only so that we have an ease of comparisons in a long-term perspective. Got it? Now current standards, you want 50 as the passing marks and I give you, can you please get 55, 60? So you say yes, a bit more effort and we can get it. Not a challenge, ma'am. But still not that motivation is there, right? The one that is to be there. So for that we need attainable standards. So current standard means typically it is for a short run and it is for the current period. Definitely, what levels were you at the current levels? You are generally expecting them to be at the current levels only at the future time also. But it is generally for a short run. But like I told you, when you have short run disturbances, short term issues, like for example, around the world, there are different, disturbances taking place, but that may not be for a long term. That is only for a short term. So then we can have current standards so that the company remains afloat. The question is that the company should remain afloat. It should be able to meet its cost, have the margins and have the selling prices for its products. For example, a restaurant sets the standard cost of making one pizza at 5.5 for the current month based on today's price ingredients. However, if the next month the price increases, only then the pricing will be updated. But for this month, we have kept these average pricings stable. Okay, so that we can have the comparisons. Got it? Now you go and buy the burgers, right? From McDonald's, from KFCs, or from different other places. You buy your burgers, pizzas, and all. So last week also the price at which you bought it, last month also that you bought it, and now it remains same. It is not that every day the prices are not changing for the veggies, for the products, but averagely the prices are remaining constant. So till the time they really don't escalate much, the prices generally don't change. Okay, this is where current standards play a role. I hope I'm clear. Any questions, any doubts, guys? Feel free to ask me quickly. I think let's have a question, because the moment we have a question, we have our doubts cleared. Okay, let's have a question here. Okay, so let's have this question, and this question is on attainable standards. So now this question says, the fastest time in which a batch, the fastest time in which a batch of Okay, now the fastest time in which a batch of 20 spicy meat special sandwiches has been made was 32 minutes. It's like the ideal time, 32 minutes. right? So I can type in here the ideal time. "32 minutes. Okay. With no hold-ups. So of course it's the ideal time. However, work studies have shown that on average about 8% of the sandwich maker's time is non-productive, and that is in addition to this, setup time is also there. So first, if I have to look in from the point of view of attainable standards, I will have to take into account these delays and the setup time. So can we calculate what is the total time again, from the attainable standards point of view? Let's do it. So ideal time is 32 minutes, which is representing 92%. Correct? Now I need to make room for delays, the non-productive time. Now look here, the non-productive time is how much, my friends? 8%. So can we do that calculation? Let's do that calculation. Okay, so non-productive time will be, now we will use a formula. If 32 represents 92%, then how much is 8% of the time? Okay, let's do it. So 32 divided by 92 multiplied by 8. And I get here the total time becomes, and I'll have to add the setup time also, right? So I will add here setup time. Setup time is 2 minutes, correct? Setup time is 2 minutes. Now let's add the 2 and we get the total time. So I will add 32. I will add non-productive time because that is a time that we will consider in attainable standards, right? That is the time that is including the errors, delays and everything, and we include it for attainable standards. So I will add the non-productive time and I will also add the setup time. I get total time as 36.78. Okay, I get total time is 36.78 minutes. Now, what is the attainable standard labor cost for one sandwich? First of all, this is the total time for 20 sandwiches. So first, let's get the total cost for 20 sandwiches. So I can write here total cost for 20 sandwiches. So what is the total cost for 20 sandwiches, people? Let's calculate. It will be, this is the time, but it is in minutes, remember. And we have been given the cost per hour. So I divided by 60 to get the cost in time in minutes. And then I will multiply it with the cost per hour, which is 4.5. Right, so I get the total cost per hour. Okay, this is the cost per hour in dollars. So total cost per hour for a 20 sandwich. Sorry, not per hour. The total cost for 20 sandwiches is $2.75. Right, $2.75. So what is the cost for one sandwich? Can we calculate it? Easy. So I will write here the cost of one sandwich is cost of one sandwich. Okay, what is the cost of one sandwich? So the cost of one sandwich will be simple. This is the total cost for 20 sandwiches. So I will take this and I will divide it by 20 and I get a cost of 0.138. $0.138, which is the cost for one sandwich. I hope now with this we are clear how to calculate the cost as per the attainable standards, even for that matter as per the ideal standards, and any questions you may have you can put up in the chat box. Very good. Now my friends, let's go further and let's understand few more pointers. So just let's look at the list and see what we have covered. We still have to cover. Now we will be covering about absorption costing and under or over absorption of overheads. So I have not given in the list here, but see, we covered about the standard costing, we covered about the types of standards, and now I will cover about the absorption costing here as well. So I will just insert the 10th point that we have covered, and we have covered about standard costing. Okay, so I will just tick it. Now, I hope we are clear on it. Now, let's go further and discuss the other pointers. Okay, I would just like to give you one practical example that how standard costing is applied. So, we have been discussing about. Yes. I will explain again about how the productive time came in place. Absolutely, I'll explain it. So now explaining it again, Sahitya. Now just look here. 32 minutes is representing how much? It is representing 92%, right? Because it is without errors, without any problems. Got it? Now, when we have attainable standards, I will take into account delays. We can apply the normal concept like we do a proportionate cost concept. So, if 32 minutes is representing 92%, how much is 100% simply? Okay? Or how much is the 8% delay? Because when you add 92 and 8, you will get 100%. So here also I will write down 8%. Okay, so now what I did here, I took 32 divided by 92. You can see in the formula divided by 8. Multiplied by 8. So I just got the relevant minutes for that 8% delay that we have wasted. That was approximately around 2.8 minutes. Now I add the two and I get the total time. But we need the setup time also, because that is also part of your attainable standards when it comes to taking into account delays, right? So I've added that also, and now I get the total production time as 36 minutes. Okay, and 36.8 minutes. Now I know the cost per hour is 4.5. So what is the cost for 36.8 minutes? We can calculate. How I did that? I did it because this is in minutes. I divide by 60 to convert it into hours and multiply it with 4.5. Finally, I will take out the cost of one sandwich and I divided it by 20 to get the cost of one sandwich. Okay, any questions now, Sahitya? Are you absolutely clear? And others also, are you absolutely clear till this point? Now, let's move on further and let's understand this topic where I was taking the example of McDonald's. So this is just to tell you practically how standard costing is applied. So just look here, my friends, and just see how standard costing is applied. I've taken the example of McDonald's. Like restaurants traditionally found it difficult to apply standard costing, but then we can see for McDonald's, where every time you buy the burger, like I told you, I think for many years I find the same pricing to be there. Maybe I think, or if I don't say years, I'll say many months. The same pricing is there. So it is clear that they are following standard costing, because otherwise, how would they have the same pricing all the time? Got it? So now restaurants traditionally found it difficult to apply standard costing because every dish was different to what was prepared the last time, because there was a lot of manual intervention in the preparation. McDonald's, it created automatic machinery involvement in the creation of the dishes, where everything was measured as per a required quantity, and it would go into the manufacturing with the machine utilization, and you will always get the same product, same taste every time. Got it? So McDonald's attempted to overcome these problems by making each type of product identical. Now we know each time you have a Big Mac, it is the same choice. I mean, which one you like the most in the burgers? I personally like McAloo Tikki. So every time I go for McAloo Tikki, it gives me the same taste. I'm sure you all also have the same taste. Only every time you pick up your point dishes. So this was by making the reduction in the human involvement. Okay, by making the reduction in the human involvement, the staffs do not pour the drinks themselves, but for everything they have machine. The staffs are just there to operate the machines. Work is done by machines only. So that is where your McDonald's roles comes in place. Okay, so I think we know it now with an example for sure that standardization can be introduced in the capital intensive industries more rather than labor intensive. Okay, now let's go further and now have a very good understanding of this topic, which is absorption costing. Okay, I think guys, we can just have a query discussion. Okay, these all have been resolved. Yeah, all the queries that have been put up by you all. So any queries till this point, please tell me, because then we will start with absorption costing. We will understand about over and under absorption with examples, of course, and we will also do a brief up of marginal costing here. Okay, now let's go further and let's understand absorption costing. I know this is a costing method that we always think we know, but frankly, I'll tell you, we don't know completely about it, because the question comes in, ma'am, what is absorption and what do I mean when I say that the costs are absorbed in the product cost? What does it mean? Absorption simply means that all the cost of production, all the costs, direct, indirect, fixed, variable, all the costs that are relating to the production of a good will be included in the product cost. Simple. So when I say absorbed in the product cost means you will add it to the product cost to calculate its margin, to calculate the sales and so on. Clear? So now when I say absorption costing, it simply means that whatever cost you can think of from the production point of view, direct cost, indirect cost, variable cost, fixed cost, my friends, all of this would be a part of your product cost. All of this would be a part of your inventory cost when you are valuing inventory as well. Okay? So in other words, I've just simplified it. In other words, the absorption costing says the direct cost, variable production overhead, fixed production overhead, Everything will be included in the cost of each unit produced that we calculate. So every unit of inventory, like we just discussed, absorbs. That means you are going to value the inventory at a cost which is total cost, which will include both variable and fixed, but only production related cost. Okay. Absorption costing is only for calculating production related cost. We don't calculate here the selling cost, distribution cost, administration cost. No, only production related cost. Okay. That means how much is the variable cost, how much is the fixed cost. Okay, so now if I just sum it up, absorption costing is nothing. It just tells you what is the cost that you're going to absorb in the total product cost. Are you going to take into account direct cost, indirect cost, like variable, fixed? I'll say everything. Every cost that relates to the production of a particular good, you are going to include it in your cost. There is a term that is written here, fixed production overhead is going to be absorbed. It means what? Like I gave you the example, I'll just quickly explain you here. Okay, so here what we are going to understand is, let's say the company manufactures pencils, erasers, sharpeners. Okay, it is incurring the rental cost, which includes for all three of them, because they all are part of the same factory, so all three of them. Now, absorption costing simply tells me, or this is a method that we simply take just to calculate how fixed overhead will be allocated to pencils, to erasers, to sharpeners. Why? Because they are common fixed cost. So we need to know a basis on the which we will allocate them. So in this absorption costing method, we are just going to understand that how do we allocate this fixed overheads into the different product cost and based on what criteria. Okay, so this is where we will do a detailed understanding of this absorption cost. So absorption costing methods, on tomorrow when we will study about the ABC costing methods, they are basically the costing methods that help us to allocate these fixed costs among the different products. Okay, now let's go further. So now quickly we need to know this thing. In order to allocate the fixed cost among the different products, we need to know what is the budgeted overhead absorption rate. This is nothing but overhead absorption rate. This is simply that you will calculate that at what rate the overheads will be absorbed in the product cost. Like we have the pencils, like we have the erasers, like we have the sharpeners. So how we are going to absorb the fixed cost into these products? For that we calculate overhead absorption rate. Okay, and how do we calculate overhead absorption rate? For that, do you see the term here, budgeted or predetermined? The standard point that comes in place. Because right now, the costs are like, the products have not been sold and we are still calculating the cost. We are putting up that cost. And so we need that predetermined rate to go ahead. So always remember, my friends, that you will always absorb cost into the product cost, this fixed cost, on the basis of the budgeted overhead absorption rate or the standard overhead absorption rate or predetermined overhead absorption rate. Question will always confuse you where you'll have the actual rates always there. But now you know logically, I will get my actual rates after a year but currently I have my budgeted rates available with me, with which I have to complete my product costing. So I will always do costing of a product while taking into account its budgeted rate. Keep this fixed in your head. Okay, so we will always take budgeted overhead rate or the standard rate or the predetermined overhead rate, whatever you call it. And how do we calculate it? We will take the total of the budgeted production overhead. Because like I said, selling, distribution, administration, we don't consider here. We take them as actual and we add it as a period cost. Okay, but we don't take them in the calculation of production cost. Makes sense, right? Because they're not production cost. And I need to calculate what is my production cost per unit. So I will take into account my budgeted production overheads and I will divide it by, now you know why I call it overheads? Because these are indirect costs, right? They're not your direct cost. So I will take budgeted production overhead and I will divide it by the budgeted hours. It can be hours or it can be units. Why do we take units? Why do we take units? Because sometimes if we think that, hours are not the correct base, then we can take the cost per unit also. Otherwise, advisable is always hours. You will see whether the entity is a capital intensive or a labor intensive. Accordingly, you will take the hours, machine hours or labor hours. Okay. So now you will calculate the budgeted overhead absorption rate, and based on this rate, you will absorb the fixed overhead cost into the product cost. So summarizing it, absorption costing simply tells me how would you absorb the full cost in a product. Okay, for that I need to calculate what is my fixed cost, because that is common for the different products. So in order to take the fixed cost for particular products, I will take the budgeted overhead absorption rate, which is simply what? Absolutely correct. Budgeted overheads divided by the number of labor hours or machine hours, as the case may be. So now what is the next point? Ma'am, can we take a question to understand it? Of course we can and we will. So now let's go to the question and understand this better. Okay, now here I have taken a question. Let's understand it. Okay, I hope everybody is able to see my screen. Yes, any challenges, any questions, my friend? Okay, now let's calculate as per absorption costing, what would be your, that is also known as traditional absorption costing, and I'll tell you reason why it is called traditional after this. Okay, so be there for the class till the end, because we are going to cover a lot of interesting concepts like absorption costing that we are covering here, over and under absorption, marginal costing, budgets, and some more discussions. So be there. Now, traditional absorption also we call it. Okay. And now the question is asking us to calculate full production cost. So then also the profit per unit for each product. So now we need to know what is the full production cost and the profit per unit for the product. Let's do the calculations. I will list down the products. My first product is Sky Bar. The next product is Moon Egg. The third product is Sun Bar. Okay, first I will take into account the direct cost. It is, and we need the cost per unit. Okay, so we will always need the cost per unit. Remember it, unless question asks you otherwise. So I will first add the direct material cost, which is given to me very, very clearly. So I will write here direct material. Okay, the cost here is given to you per unit. So direct material is 0.17 here. Okay, let's put it 0.17. Let's put direct material. Okay, now let's put the cost here, which is here 0.17, 0.19 and 0.16. So 0.17, so this is 0.17, 0.19 and this is 0.16. Okay, this is for direct material and this is for direct labor. Direct labor is also given to you per unit, which is 0.07, 0.14. Okay, we will write here direct labor 0.07, 0.14 and 0.12. Okay, now we have got all these figures in place. Now we have got this, so we can calculate the prime cost. Let's have the prime cost calculated. So that will be 0.17 plus 0.07. Now here it will be 0.19 plus 0.14. Done. Now here it will be 0.16 plus 0.12. Okay, I hope it is clear. So we have got the prime cost. Now what we need to add is, we just need to add the production overhead. That's all. So prime cost plus production overhead will give us the total cost. So let's calculate the production overhead. For that, now I need to calculate the OAR also. That we will do in a working that I will show you here. But in the performa, I will add here production overhead. Okay, let's do the working here. Working. Now what I need to calculate for production overhead, I need to calculate the budgeted OAR rate, right? Budgeted overhead absorption rate. Let's calculate it. So I would need budgeted overhead absorption rate. Okay, and we know the formula. Still, I will just write it down so that we are clear about it. And that is equal to budgeted overhead divided by. Now here, let's see what we will take as the base. Should we take the number of labor hours as a base or machine hours as a base? Now, when you have both, you will always take the base as the ones which is used more. So you would know the entity is a labor intensive or a machine intensive. Now you can look in the question, direct labor hours are 0.001. Right? The direct labor hours are The direct labor hours are 0.001. The machine hour is 0.01. Here again 0.01, 0.04, 0.005, 0.02. What does it mean? That machine hours are more than the labor hours? Yes? Everybody is with me on this? So when machine hours are more than the labor hours, then we clearly know that it is more of a machine intensive or a capital intensive entity. Right? So then what we will do, I will take the base as the number of machine hours. Right? So in my question or in my example, I will write it here in this formula that we were writing. I will write it here, budgeted overhead divided by number of machine hours. We need to calculate the total number of machine hours. Let's calculate. Okay, so here I will write one by one. First, what is the budgeted overhead? So budgeted overhead is equal to, here it was given, right? 80,000. So I will write here 80,000. Now let's calculate the hours, that is machine hours. We can use the formula to do it. Let's do it here. So I will use the formula. I will use the brackets open because I will have to add the machine hours of all the three products. Okay. So let's add the machine hours of all the three products. 0.01 it requires. See, Skybar needs 0.01 machine hours to make 1 unit. So how many machine hours it will need to make 5 lakh units? Because I need total machine hours. Okay. So we can use the formula here. That will be 5 lakhs multiplied by 0.01. This is for Skybar, bracket close, plus. Now let's do for Moon Egg. 1,50,000 is the number of units for Moon Egg, multiplied by each unit requires 0.04 machine hours. Plus. Now for the Sunbar, it requires 2,50,000 is the number of units, multiplied by each unit requires 0.02 machine hours. Okay, we have taken for all. Now I can press enter and I will get the number of machine hours. So total number of machine hours are 16,000. Now can we calculate the budgeted OER rate? I'm sure we can. So I will write here. Budgeted OER will be equal to, let's use the formula guys, will be equal to 80,000 divided by 16,000. And I get 5. So that means my OER rate is 5 per hour. Okay, clear? Now we can easily give the overhead cost here. So it is 5 per hour. How many hours? We have already calculated for machine. Right? We can do it. So we need to multiply with the number of hours per unit. Because this is the cost that we need per unit. Number of hours per unit is given to you 0.01. So I will do here equal to 5 multiplied by 0.01. Here I will do equal to 5 multiplied by 0.04. And here I will take equal to 5 multiplied by 0.02. Okay, we've got the overheads, we have got the prime cost. I hope everybody is with me on this. Now we just need to get the totals. So I will add it here and I will get here total cost. Total production cost. So total production cost is per unit, right? Total production cost per unit will be .24, which is the prime cost. .24 plus 0.05. Okay, and here your total production cost per unit will be, now just add it, equal to 0.33 plus 0.2. And here it will be equal to 0.28 plus 0.1. Right? So people, I think we are clear. Now we know about that how do we calculate the total production cost by following the absorption costing method. Any questions, any doubts, put up in the chat box. Last point was to calculate the profit per unit. Now you know your selling price. You can reduce selling price from the cost to get the profit per unit. Okay? Easy. I'm sure you all can do it. Right? Any questions, any doubts, put up in the chat box. Okay, that's great. That's great. Okay, now let's just have a 10 minutes break, and post which we will complete the over under absorption. We will do a question, we'll do marginal costing and so on. So let's just resume in 10 minutes. So see you guys in a 10 minutes break. After the break. welcome from the break. I'm sure now you all have even more double energies, because I think even I'm carrying that level of energy that you all have. Okay, so far I'm sure that all of the topics that we have covered are always crystal clear, 100% to all of you. Okay, let's go on forward. And we were discussing about the absorption costing. In absorption costing, when we covered the OAR rate, now a question can come in your mind, and that can be, ma'am, we have taken in our costing sheet, that is the expenses that went into the P&L, right? In P&L, we take okay, now just see, in P&L, we take indirect expenses, correct? In case of overheads, at what rate we have taken them? We have taken them at overhead absorption rate, which is nothing but a standard rate. But of course, there can be variation, and this was the cost per unit that we took. Right? Keep listening to me. Now, when we have the actual cost, that can be plus or minus than this rate. It can be more than this or less than this. Correct? We need to take out the difference. Why? Because ultimately my P&L should show the actual expenses. So now we need to bring them down or bring them up to the actual levels. So here comes the concept of under oblique over absorption of overheads. Now logically why we are taking it, because ultimately in my cost sheet from the starting, what went? It went only the overheads that were absorbed as per the OAR rate. But we never took into account the actual overheads, which is taking place at the period end. So now we need to make it, matching with the actual overheads. So here we take the concept of absorbed over or under overheads. Okay. So let's see whether my overheads were under absorbed or over absorbed. Let's take an example, and then you guys will tell me it is over or under absorbed. But for that, first I need to take the formulas. Now formula is not difficult. Here we can frame the formula. Okay. What rate did we take? Overhead absorption rate that was budgeted. Okay. We also took, when I calculate here, so first I need the calculation of absorbed overheads, and then I will do the calculation of actual overheads. Clear? Now what are absorbed overheads? Now I need this in total. I don't need per unit. I need for total value. That will be in typical dollar value. Now, whenever we take units, of course, now I am checking this position at the period end. I have my actual units with me. So one thing is very clear, that I will multiply it with actual units. What I will multiply with actual units? Just think in the cost sheet what data I had. I had the cost per hour, right? So here also I will take the budgeted cost per hour. Okay, I have the budgeted cost per hour, that I will multiply it with the number of actual units. Let's say that we are multiplying it with the budgeted cost per hour, but then you will say, ma'am, you are taking actual units. So there is one more thing that we need to multiply, hours per unit. Budgeted cost per hour multiplied by hours per unit multiplied by the actual units will give me a full picture. Correct? Comes the next point, and I hope all of you are listening to me very carefully. Okay, which is the next point, that when I'm multiplying it with the hours per unit, what I should take into account? Remember the cost sheet, when we had the direct labor hours, when we had the machine hours, which hours we took? Did we take the standard hours or did we take the actual hours? Because we are calculating it since the beginning. So what is the logical correct value? Should we take actual hours per unit or should we take what was the standard hours per unit? Tell me in the chat box. Absolutely correct. I know. Actual units is what we will always have for sure. We know we had the budgeted OAR rate per hour, that also we had it. Right, for absorption costing. Now we absorb the overheads at a predetermined hours per unit. So again, you will take that here. So you will have here what is the budgeted hours per unit. So I hope this formula is without rote learning absolutely clear, because when we absorbed overheads, we always absorbed at per unit. So I had what is the budgeted hours per unit and we multiplied with the budgeted rate per hour. But now we are checking the entire values at the end of the period. So I have actual units with me. Hence we are multiplying it with actual units. Clear? Now actual overheads will be what? Actual cost. Actual overhead cost. Clear? So now when the question comes in, I'm sure guys you all will be absolutely clear. First you will calculate what is the budgeted absorbed labor overhead rate per hour. Okay, or per unit simply. What is the budgeted rate per unit multiplied with actual units, because you are doing this calculation at the end of the period when actual data is already with you. Now we see whether it's an over-absorption or under-absorption. So let's have a very simple example. Very good, Jamin. Okay, let's have a very simple example. Okay, the simple example is, let's say my absorbed overheads were 20,000. My actual overheads actually that was incurred was 15,000. So in my P&L, have we shown more overheads or less overheads? Absolutely correct. We have shown more overheads. Why? Because we accounted for P&L costing during the year and we followed absorption costing. So we absorbed the overheads at 20,000. But actually my overheads are only 15,000. That means I have to show the P&L and actual values. So what I will do? I will reduce 5,000. And what is this called? Over-absorption. Because you had done over-absorption, now you will credit the P&L by 5,000. Initially you debited the expenses and you debited the P&L by 20,000. Now you would reverse 5,000. So you would reduce your P&L by 5,000. Very good, very stunning. So now here I've reduced it by 5,000. So I will get 15,000 as my actual overheads. Let's solve a question, people, to be absolutely clear about it. So I take up a question, which is this one for absorption costing. Under or over absorption. A company budgeted to produce 3,000 units. This is the budgeted units, okay, of a single product in a period at a budgeted cost per unit. Your budgeted cost per unit is given to you 9. Okay, this is given to you at 9. In the period covered by the budget, actual production was 3,200 units. and actual fixed cost expenditure was 5% above the budgeted expenditure. What does it mean? Now you would need to calculate the budgeted cost, and on that you will add 5% to get the actual cost. Okay, this is the baseline. All other costs were as budgeted. What is the amount of over or under absorption? I think we can do it here, and let's do it here. So first let's write what is the absorbed cost. Okay, what is the absorbed cost? 9 is the overhead absorption cost per unit. So we know the formula per unit is already given to me. I don't need to take per hour and all. So I will take 9 and I will multiply it with actual units. Actual units are 3200 given to you here, 3200. So I will take into account 3200. Okay. So I will multiply here 3200. I got the absorbed cost 28,800. Now I will take up the actual cost. Now the question says your actual cost is 5% more than the budgeted cost. So calculate the budgeted cost. Budgeted cost, not absorbed cost. Budgeted cost is budgeted units multiplied by budgeted rate. Budgeted units are given to you 3000. So I will take 3000 multiplied by budgeted rate is given to you 9. I will multiply 9. I get 27,000. Now please tell me in the chat box. If this is coming as 27,000, absorbed cost was 28,800. Friends, okay, my dear students, is it over absorption or under absorption? Quickly type it in the chat box. I'm sure you all got it correct. Very good. So it is an over absorption. Why? Because my overheads that went into my P&L is more than the actual overhead. So it is overhead absorption. Over, I will show it is a negative sign. That would mean that I would credit my P&L by 1800 so that I bring it down to the actual levels. I'm sure everybody's got hold of this topic. So let's go further and let's understand the marginal costing. Marginal costing is another very interesting method of costing. So we have done standard costing method. We almost touched upon and completed our absorption costing method. We completed our over and under absorption calculations. And now let's understand marginal costing. Marginal costing, you know, we always call as a modern costing method. And we call absorption costing as a traditional costing method. Okay, why? Because see, absorption costing always says that you would absorb full production cost to the product cost, whether it is fixed or variable. With the only reason that in the previous times, you know, in the historical times of let's say 1950s, 60s and all, that time your variable cost used to be very high. The fixed cost used to be very low because we never had those expenses like advertisement, promotions, marketing and all, which is nowadays, I mean, it's the foremost. You can see the example here. Okay, so now considering those angles, nowadays the shift has reversed. Now variable cost is not that high as your fixed cost. But when I have to decide whether I should go for a product manufacturing or not, it's the variable cost that would matter, right? Because fixed cost will as it is be covered whether we manufacture this product or not. Because with the other products that the company has, it would still be covering its fixed cost. So absorption costing never took this angle. Okay, and it made the costing very bulky. So when I talk about marginal costing, it makes the costing very light. And it says that, boss, what is your focus area is only variable cost. Your focus area is not the full production cost. So every entity should try to maximize its contribution. So when you want to maximize your profits, don't looking into the fixed cost. because that is going to be incurred anyways. Whether you incur a profit or a loss, that will incur. So why don't you focus on increasing your contribution? Now you will say, ma'am, what is contribution? Contribution is simply, look here, sales less all variable cost. All variable cost. Not just production. Your selling, your distribution, all variable cost you will reduce. Because variable cost is in the control of the entity. Understand that. Right? Variable cost is in the control of the entity. The more goods you make, the more is the variable cost. Low goods you make, low is the variable cost. Right? So variable cost is something that can be controlled. So every entity should focus on maximizing its contribution, because it is representing the extra earning per unit that the entity will have when it is selling one extra product. Okay, extra earning that the entity has by selling one extra product. Because fixed cost will, as it is being incurred, it's a period cost. So it will have no impact on your decision making. Okay, so therefore, marginal costing says your focus area is not your fixed cost. Your focus area is your variable cost. Okay, so therefore, your fixed costs are the period costs that will always be written down, always be written off after you have calculated your contribution. So every entity should focus on maximizing the contribution rather than maximizing the profits. Because if your contributions are maximized, your profits will eventually be maximized only, as your fixed cost is already at a set level and you cannot do much about it. So marginal costing says focus on variable cost, focus on contribution, focus on maximizing it. So if contribution is more than the fixed cost, you will have profits. If contribution is less than the fixed cost, you will have losses. Clear? Absolutely. Going further. So now comes the question why it is so useful, like we have discussed, because it increases in direct proportion to the number of units sold. So if an entity is motivated to sell more units, more will be the contribution, more coverage of fixed cost, and more will be the profit. So if profit rises as sales rise by the amount of this extra contribution, because fixed cost is fixed, that is not changing for that period. So what is changing is only contribution. Okay. Now here I've just given a clear difference of marginal costing and absorption costing, so that you have even more clearer view of the thoughts. Okay, which I'm sure you can always go through whenever these notes are given to you, because now we know absorption costing, now we know marginal costing in detail. All those who want to get access of these notes and those who are not in the live classes group, you can always ping me here in the chat box, and I would make sure that these notes which we are discussing today reach out to you as soon as possible. So please drop your email IDs or your connect, just so that I can send these notes across to you. Okay, let's do a question on marginal costing as well. Very interesting question, so that we know the answers. Now, only thing that you have to remember is, as the number of units change, your overall contribution will change, but fixed cost will remain fixed. So we will do the calculation in this table only. Okay, let's do it here. All of you, I hope you're with me to do the same. Now, a company manufactures only one product called XY. The following information relates to the product. Selling price is given to me per unit. Direct material cost is given to me per unit. Direct labor cost is again given to me per unit. Variable overhead is also given to me per unit. Fixed costs are given to me for a period, because we know it is fixed. So the moment I know it is fixed cost, in the table, I will directly write for all levels of input, all levels of units. I will write here 25,000 less 25,000. Less 25,000 and less 25,000. Because this is the fixed cost that will be reduced from my contribution. Okay. Now, revenue, let's calculate. 2,500 into 20, so that will be 50,000. Let's make it here, so we can do the calculation with formulas. This is 2500 5000 7500 and 10,000. Okay, let's do the calculations here. Now 2500, what will be the revenue? I can use the formula. $2,500 multiplied by 20. 5,000 will be 5,000 multiplied by 20. Clear? 7,500 will be 7,500 multiplied by 20, and 10,000 again the same. 10,000 multiplied by 20. Okay, so this is the sales. Then we have variable cost because we need to calculate the contribution. Sales, variable cost, contribution, fixed cost, profit or loss, and then we have contribution per unit, and then we have profit or loss per unit. Okay, we need to calculate this. Now let's calculate variable cost. Variable cost will be the total of all variable cost. Okay, so this is very, very important. Get the total of all variable cost. Which are the variable costs here? That will vary with the number of units produced. Direct material cost, direct labor cost, and variable overhead cost. Add it. So that will be 6 plus 2, 8, 8 plus 4, 12. Remember it, 12 per unit, right? Because they all are variable, they will vary with the number of units produced. Okay, now here we have variable cost. I will again multiply 12 with the number of units produced. So I will write here 12 multiplied by 2,500 units. Then here 12 multiplied by 5,000 units. Then here 12 multiplied by 7,500 units, and then here 12 multiplied by 10,000 units. Clear? Now we have got the sales, we have got the variable cost. Let's reduce it to get the contribution. So we'll have sales, $50,000 less 30,000. Okay, and likewise we can have it here. Okay, now we have it here on the same lines. I can Okay, people, I think we have got it. So we have got the, here when we are preparing this marginal cost sheet, okay, we have got the contributions as well. Now let's reduce the fixed cost. Fixed cost is minus 25,000. So let's do it. Just a minute. Okay. So now we have reduced the fixed cost as well. Okay, now let's calculate the profit or loss. So let's calculate the profit or loss, which is contribution less fixed cost, correct? So now you can see in the first case we have a loss. So let's have the profit or loss that will be equal to contribution, and here I will add the fixed cost because I've already presented in the negative way. Okay, and the same I will copy for the others. Okay, now we'll get the profit and loss for all the situations. Okay, look here, people. So now we have got the profit and loss for all the situations. 5,000 is the loss in the first case. and then we have 15,000, and then we have 35,000 profit, 55,000 profit. Now the question asks us to calculate contribution per unit. It's very easy, but you will see something here, okay, and that will give you a very good understanding. That will be 20,000 okay, so contribution per unit will be equal to 20,000 divided by number of units, which is 2,500. What do you observe here? It is coming 8. Okay, now here also I will take the same formula. Okay, so here the contribution is 40,000. 40,000 divided by, units were 5,000, remember? 5,000. Here my contribution would be 60,000 divided by 7,500. Okay, and here it will be 80,000 divided by 10,000. Okay, people, so what do you observe here? We observe that my contribution per unit is constant. It is not moving. It is constant. This shows that your variable cost per unit is constant. Hence, your contribution per unit is also constant. Now, just look at the profit and loss per unit. It will not be constant. Why? Because it has got fixed cost also. Profit here is negative 5,000. So, we'll have equal to negative 5,000 divided by 2,500 units. Okay, here it will be, the profit is 15,000, right? Equal to 15,000 divided by 5,000. Here it will be equal to 35,000 divided by 7,500, and here it will be equal to 55,000 divided by 10,000. Please see, do you find the profits per unit to be the same? No, they are not same. Why it is not same? Just because your profit per unit will move or will change because there is fixed cost involved, which is not constant per unit. But your contribution per unit will be constant. The reason being, it is based on variable cost, which is also constant per unit. So I'm sure you are able to understand perfectly this relationship. Okay, now let's go further quickly. And let's understand the budgets. Okay, the last major topic of this. So now, budgets. What are budgets? You know that we have already discussed a lot about it. So budget is nothing but a plan that you are preparing in advance, and it is based on a predetermined rate. The reason being, the entity wants to use it for control purposes, just to check what is the budgeted position and what is the actuals. So actually, is the entity doing good or well off, or it is better, or it is worse? Okay, so how the entity is doing, in order to make it on a comparative basis with its budget, we prepare these budgets. Okay, so that we have a control nature in place. But yes, I know what you all must be thinking, and I completely agree to it. Budgets have to be prepared in a very thoughtful manner, because otherwise we may have always problems that the budgets were not created properly, and so the actuals that are deriving, they may just show quite a huge difference with the budgets. So budgets, they are to be prepared in a very thoughtful way. Now, what is most important is, like for example, I'll explain you a budget also. A company may prepare a sales budget which is forecasting 50 million revenue. Okay, which is forecasting 50 million revenue 50 million revenue for the next year. Now, okay, now please see. Now, based on the sales budget, we will prepare the production budget. Correct? Based on the sales budget, we will prepare the production budget to meet the demand, and based on this budget, we will prepare the labor budget. Based on these budgets, we will prepare the cash budget. And once all the budgets are prepared, then at the end, the management will compare actuals with the budget to see if the sales, if the budgets were met or not, or actuals, they were exceeded budget or they were less than the budget. So for that, we have a comparative analysis, which we famously call as variance analysis. We will understand about the basic variances, advanced variances also when we go further in the class. Okay, but right now today's focus point is to understand about the different budgets. That is the flexed budget, fixed budget, and the flexible budget. And then we compare, always remember, you will always compare flexed budget with actuals. Okay, and then we get the variances. Clear? So you will always get variances when you compare the flexed budget with the actuals. So comes a very important point, ma'am. What is a flexed, flexible, and the fixed budget? Let's understand. Fixed budget is known as the master budget. It is always going to be remaining fixed. It will not change. It is always prepared at before the start of the year, when your budget committee and your members come together, do the planning, and they create a budget. So they give you fixed budget. It is set before the start of the current year, and it sets targets for the current year. This budget will never change during the current year. So how do you calculate the values here? Simple. You will have budgeted cost per unit and multiplied by budgeted number of units. So everything budgeted number of units, budgeted cost per unit. This is also referred to as the original budget. Okay, this is also referred to as the original budget and is also known as the master budget. Because this rate that we have fixed in the master budget will be there whether it's a flexible budget or a flexed budget. Every time the rate that we use, the budgeted rate, we have done in the previous question also, those rates are always the original master budget rate. I hope I made it very, very clear that these rates are always going to be the original master budget rate. Okay, now let's go further and see the flexible budget. Flexible. That means during the year, these units will keep on changing and increasing and decreasing based upon the change in the expectations. So you will have multiple budgets that can be created here. But master budget will not change and it will be there. You cannot discard it. It will always be there. But you can have multiple flexible budgets created just to have the revised budgeted estimations. That's all. Okay, so remember these terms, flexible budget. We will use it more when it comes to variance analysis, when it comes to budget. So this basics has to be here, absolutely. Okay, now quickly. This budget help us to revise the targets, absolutely. One thing is very important now, how would you calculate the values here? One thing is clear that what is changing here in revised budget, what is changing? You will say, ma'am, in revised budgets, my units are changing. That's all. So here, that's all you will do. You will take the rate per unit as per the original budget. Remember, in all the types of budgeting, you will always keep the cost per unit as per the original budget. But here you will multiply it with the revised number of units. Clear? I repeat again. In case of flexible budget, what is changing is only units, right? That is getting flexing. So budgeted rate will remain same as per the original budget. The units will change and you'll have the flexible budgeted units. That means the number of units will be now as per the revised budgeted levels. Now I come to flexed budget. Flexed is now your period is over. Now you do want to do a comparative analysis. So what we will do, we will keep our actual units fixed, because now at the end of the year I have actual units with me. So flexed budget is based on actual units, but what budgeted cost per unit we will take? That thing that I told you just now, the rule that you will always take the budgeted cost per unit as per the master budget. Comes the question, then why are we taking the rate per unit as per the master budget? Because that can also change. I agree. But budget is always fixed in nature, so that we can have a better comparisons. Hence, we take units actual, but rates we take always as budgeted, so that comparisons can be drawn meaningfully and corrective actions can be taken. See, if there are too many variables, then it is very difficult to do a comparison. Hence, we keep the original budgeted rate as constant. Okay, so now in this flexed budget, we will always have actual units. Here also units will only change, but here we will take units as actual. And here we took units as budgeted. Okay, the revised budgeted. And here I am taking as actuals. And that actual units I will multiply with, very good, original budgeted rate per unit to get my flexed budget. The moment you get flexed budget, compare it with the actuals and get the variances. Simple and sweet. Okay, we will do a question to understand this, but just one point. Okay, please remember that fixed cost will always be as per the original budget or master budget only. Very important. So like we prepared the flexible budget at different levels, like in marginal costing also we did. Remember that always what will change is the variable cost that you will take as the original master budget. Fixed cost in total will also be as per the original master budget only. In total. You will not change that as well. Why don't we have a look at a question to better understand it? So let's have a question and better have the clarity about it. Okay, let's have this. Using the flexible budgeting approach in this question. So this question says, using the flexible budgeting approach, prepare a table showing original budget, flexed budget and the variances. Very interesting. Let's prepare. Okay, so let's prepare here. I will write here so first I will prepare the original budget that I will just give the heading as. So I will write here original budget. Original budget, flexed budget and actuals. actuals and variances. Okay, so let's calculate these actuals, variances and the flexed original budget. Now let's see the question. So we have the question with us. So this is the budgeted rate as per the actual budgets, and actual production sales for 1 month were 12,000, and this is the original budget for 10,000 units. Okay, now flexed will also be prepared with respect to 12,000 units, right? Now let's calculate what is the selling, what is the sales, what is the variable cost, what is the fixed cost, and what is the profit per unit. Okay, let's do this calculation. Okay, so what is the sales the variable cost here? 3 into 10, 30,000. 1 into 10, 10,000 is the fixed cost. So I will just make the chart here. Variable cost, fixed cost, total cost, profit and selling price. Okay, variable cost is 30,000, fixed cost is 10,000, total cost will be 40,000. Okay, now other data is given to you here. That is given to you here. 3 is the variable cost we have taken, 1 is the fixed cost we have taken, 6 is the profit value 60,000, and 1 lakh is the sales. So let's put it here, and I will write here 60,000 is the profit. So my selling price comes out to be 1 lakh. Remember, it is your original budget. The moment I say it is my original master budget, fixed cost will be same here as well. It will not change. Only variable cost will change. So here fixed budget will be based on 12,000 units. It will be based on 10,000 units. Actuals is based on 12,000 units. Always remember this. Okay. Now what will be the variable cost here? So variable cost will be 3 into, now I will do 12,000, which means 36,000. So this is my 36,000. Total cost will be 46,000. What is the profit? The question says that the profit will be, profit per unit is 6. 6 into 12, 72,000 you will take. Okay, 6 into 12 is 72,000. So your selling price will be, you can always cross check, it is 10. Okay, when you add it here, you get 1 lakh. No, this is 8,000. And this is 18,000. So it becomes 1,18,000, which is my selling price as per the flexed budget. See the actual. So you have the actual data given to you. Let's take it. Selling is 1,25,000. Variable cost is 40,000. Fixed cost is 9,000. Okay, so I will take here 9,000, 40,000 and 76,000. So this is 40,000. This is 9,000 and this is 49,000. This is 76,000. So this becomes 1,25,000. This is my actuals. Now let's take out the variances, and you will always see with respect to actuals, and you will check between flexed and actuals only. Okay, flexed and actuals only. Now what do you see? Your flexed budget was 36,000. As per the budget, the variable cost should be, but actually we have a variable cost of 40,000. Is it favorable for the company? No, because company is spending more. Very good. So my variance is 4,000 here, negative. Now next, 10,000 was the budgeted fixed cost. Actuals is 1,000. We are saving 1,000, so it's plus 1,000. Now going to the profits, we expected our profits to be 72, but we have actual profit 76. Boss, we are doing terrific. Okay, so since we are doing terrific, we will have plus 4,000. Okay, overall when you say My sales have increased by 7,000. That is very clearly evident here. This is 3,000 and this is 4,000. When you add 3 plus 4, you get 7,000. So overall, it's a very good position for the company. The company has done great, and overall there is an increase of 7,000 in the variances. That means the company is in a favorable position. I hope this gives you absolute clarity on the fixed budget, flexible budget, actuals, and the flex budget. Any doubts, please put up in the chat box. Okay, so I hope I'm absolutely clear about it. And now we have done attainable. We have done attainable standards. We have done the fixed flexible budgets. One more concept and then we will be done for the day. Okay. One more concept which is very important and interesting is a controllable cost. You will find this concept to be coming regularly in your PM topic. What is a controllable cost? Controllable cost means what? Like I'm a manager, okay, and I'm handling purchases, so what cost I can control is only the price that I can negotiate, only this much. What if the market price is increasing? Then that's not something that I can control because market price is increasing. If the management says that, boss, your performance will be evaluated based on the cost that you are monitoring, and because this time we paid more cost than that was expected, we will reduce your bonus. You will not get bonus. Purchase manager says, boss, I did not do anything. Market only increased because we had an economic downturn. So things have become expensive. Now, what is my role in it? Management says, no, we don't know. You had to take care of purchases, so it's your responsibility. Now, what would you do in this case? You will feel as the manager that this is unfair. Absolutely correct. So this is where we come with a situation of controllable cost. Okay, so controllable cost concept simply says this point. Controllable cost concept says that, boss, a manager should only be evaluated with respect to the cost that he can control. The cost that he cannot control, how can he evaluate his performance based on it? So remember this term, controllable cost, uncontrollable cost. In our example, the negotiations that he can do is controllable. The negotiations that he cannot do because market has increased or escalated, that's uncontrollable. I hope I'm absolutely crystal clear on the same. Now going further, let's have a small example to discuss this. The material purchasing manager is assessed on the total expenditure of the organization, the cost of introducing safety measures regarding the standard and the quality of materials in accordance with the revised government legislations. A notional rental cost allocated by HO for the material storage area. Now please discuss whether these costs are controllable by the manager or not. So now I'm sure, guys, thoughts are coming to your mind and I completely agree to it. When you look at the first cost, total material expenditure for the organization, the manager would only be responsible as regards the material purchase cost, and that too limited to his negotiation power. Any cost which is beyond it, due to the market increase or other escalations, he should not be evaluated on that cost because it is not controllable by him. Clear? Moving forward, the cost of introducing safety measures. Yes, this is something that he can control, right? The cost of introducing the safety measures, because that is needed as per the government regulation. This is something that he can control. So yes, on this, his performance should be evaluated. But now when we discuss a notional rental cost, how can a purchasing manager be evaluated on the notional rental cost? That's a simple cost allocated by HO, so that's not his area. So definitely it is not a cost that his performance should be evaluated upon. I hope when I go to this basics concepts list and just see the topics that we have covered. Now just looking into it, we have covered topics like basics of costing, direct indirect cost, types of cost as per nature, overheads, under and over absorption, marginal costing, absorption costing, budget, fixed, flexible and flexed budget, and standard costing. I will just take quickly this topic, TQM and JIT. Remember I was talking about Toyota. I was talking that they apply the ideal standards. So they're able to apply it because they have the TQM and JIT environment with them. You'll say, now what is TQM and what is JIT? TQM means total quality management. It simply means that, boss, don't say, oh ma'am, I've just started with the studies now. I cannot get my answer correct in the first time, no? Let me study for another 10 days, 20 days, 1 month, 2 months, and then I'll get my correct answer. No, we don't have time for that. So here we have the TQM concepts that says, why are you waiting for the next time? Get it right the first time only. So that there is saving of cost, saving of effort, saving of delays. You know, all these problems are solved. And Toyota applies TQM. It applies TQM in its manufacturing process, in its production process. And people, if you study this in detail, you will find they have been successful. They were the first companies that applied it and they were hugely successful. And even today, they are very successful. So they have a lot of cost controls. That is why in place, because they have removed the room for errors and delays. Next is JIT, which again they have applied in their manufacturing process. JIT, just in time. I want to manufacture the goods. Okay. I will get the materials just in time when I demand from my manufacturer, from my supplier. I want them today. I want 100 units for raw materials. He'll supply me today. Tomorrow I want 200 units. He'll supply me tomorrow. So it has to be such perfect connects. The moment you place an order here, it is linked with the supplier system. Supplier will send it without any failure. So of course, you would need a proper logistics, proper arrangement with the supplier, which sometimes we feel, now in India, you will be able to do it. Yes, of course. Again, Toyota has been a benchmark company here as well. They've applied JIT with absolutely no glitches. No glitches. We had a technical glitch in our system, but here they had no glitches. Okay, so now we say that JIT technology will help us so that there is no need to have the extra cost, of inventory holding. You can remove that cost, you can remove the storage, you can remove that warehousing cost, storage cost, everything. Just see the amount of money that will be saved because you're, having the JIT in place. But of course, for that, you have to be having a real-time support from a supplier. It has to be perfect, accurate, to the point. And just when you need, the supplier should be ready. And not just one supplier, a bunch of suppliers or many suppliers, network that has to be there. So if one supplier does not have it, another supplier sends it. It has to be very, very well maintained and, perfectly accurate, real-time network that has to be there. Once we apply TQM and JIT, ideal standards don't do look. And for PM, for management, please understand TQM and JIT, they play a very important role. And now even Boeing is also having the JIT in place. They also have TQM and JIT that they have incorporated into their systems. Okay, so this gives them a lot of cost advantage, cost benefits, and, and it gives them a lot of threshold to minimize the cost and thereby working on their margins or even working on the price that they're offering to the customers. So that's all for today's basic concepts classes, guys. We covered approximately 10 topics with multiple examples. I am sure, very sure that these concepts are going to give you an added advantage, added edge when you appear for your PM, for December attempt or any forthcoming attempt. These are the basics that we cover as a requisite, okay, so that you are absolutely 100% crystal clear with the concepts that we will be doing henceforth. And do join tomorrow at 8 a.m. And please join my YouTube channel, which is by the name of ACCA with Anshu Budhia. Join the channel, join the Telegram link to get the regular updates and to get more videos and more explanations. You have any questions, any queries, you can always drop down in the chat box. You want to get a copy of these notes, drop down in the chat box, okay, and we will make it get supplied to you. For any further details, you can reach out to us and we will be more than happy to connect. But for now, see you all tomorrow at the same time and with more new topics, particularly related to your PM. Thank you so much. Have a great day. Have a safe day. Take care. See you tomorrow. Don't be late. I would be waiting for you all. Bye-bye.